Hi everyone, and welcome back to the show. My name is Jim Evans, President of Gannon Security Partners, and today we're talking about whole life insurance. We've talked in the past about using a GUL, which is a guaranteed universal life contract, a universal life contract, an indexed universal life contract. We've talked about term policies. We've talked about annuities. We haven't talked about how to use a whole life policy. Now, if you listen to certain commentators like Susan Orman or Dave Ramsey, they hate this stuff. Not really sure why they hate whole life policies. You'll hear a lot of people say, buy term, invest the rest. So that's obviously your prerogative, but we just wanted to show how you could potentially use a whole life policy in your planning. What are the benefits of it? How does it work? So that's what we're going to go through today. All right, let's jump right into it. All right, so let's go over the benefits. A whole life policy builds cash value. So as you pay your premium, a certain amount of that premium is going to go into your cash value, okay? That cash value is going to have no stock market risk. It absolutely has no risk whatsoever associated with the market. So if you have $15,000 inside your whole life contract and the stock market plummets, you will not see any negative effect at all in your account. Liquidity at any age. The reason I bring this up is there are certain people, I happen to be one of them, so I'll disclose that use a whole life contract for my retirement planning. I don't actually use a 401k because for me personally, it doesn't make sense to put the money away into a 401k, have that money locked up until I'm 59 and a half before I can even touch it without a 10% penalty. And it also doesn't allow me to have no market risk. So in a 401k, obviously you're going to have that invested in mutual funds, ETFs, stocks, bonds, those types of things, which have interest rate risk and stock market risk. So some people use this. The benefit of using this for retirement is that, and I shouldn't say you should use it for retirement, it's a supplemental retirement avenue, okay? But for instance, I can touch this money at any age inside my account. I don't have to wait until a certain age before it becomes available to me, so that's another benefit that you have. Long-term cost could be zero. It really should be zero. Now, the only way that would change is if you purchase the wrong type of whole life policy from a carrier that really doesn't specialize in that area. They're better for term or universal life or GUL or any other type of life insurance contract, and their product selection in the whole life isn't really that strong. It doesn't pay a good dividend, doesn't really have some of the features that are necessary to make that work, to have a zero cost. The reason I say zero cost is because as you pay the policy, let's say you have a 10-pay policy, a 10-pay whole life contract, and you pay that for your full 10 years, really you should be plus. You should have more cash value than the premium you put in. Again, that depends on your age, your health, what type of risk rating that you get approved at. But in reality, you should have more cash value, or at least at minimum the same amount of cash value in your policy of the premium amount that you put in over those 10 years. So when you really look at it, what did it really cost me to get that death benefit if I put, let's say, $10,000 into the policy and I have $10,000 in cash value? I could pull that $10,000 in cash value out. I had that protection with the death benefit that entire time, and really it cost me nothing. There are people that would go out there and say, well, there's an opportunity cost. You could have put that $10,000 in something else. True, and I would be the first one to agree with you. You could put that $10,000 into another vehicle, but you have to assume some type of risk there, so just be careful of that. Can offer tax-free loans. So we're going to get into this a little bit later, but the cash value that is inside your account, like I said, you can touch earlier than a certain age, like 59 and a half for qualified funds. That is like tax-deferred 401ks, profit-sharing plans, defined benefit plans, IRAs. Those are all qualified funds. This is not. So you won't get a tax deduction for putting the money into the life insurance contract, but when you're pulling the money out, you can take it out in the form of a loan, which is never taxed. So you'll see when you take the loans out, the better carriers, your Mass Mutuals, your Guardians, your MetLifes, their products will have an interest that they're going to charge you, and I'm going to get to that in a second, but that's going to be a heck of a lot better than the taxes that you would pay if you pulled money out of a 401k or an IRA. Loans are from the general account, not your account. So this kind of goes into two things. One, it's a great segue into what we were just talking about with the money coming out of the policy in the form of a loan. Let's say you're getting charged 4%, 5%, 6%, somewhere in that area on that money. Well, that's a heck of a lot better than paying 15, 20, 25, 30, 35, 40% in income taxes coming out of a qualified plan. Now, however, the thing you have to realize is the money is not coming out of your account. So let's say, I'll use my example, I have $10,000 in cash value, and I take $2,000 out of my account, or I take I take $2,000 loan against my account. That's actually not coming out of my account. So if the dividend that year is 5%, I am still going to get 5% on the full $10,000, not on the $8,000. So let me just go through that one more time because I want you to understand that. The $2,000 loan is coming from the general account of the insurance company, not coming from my account. So they're going to charge me 4% or 5% or 6%, whatever my loan rate is, on that $2,000. They're going to put a lien of that $2,000 against my account. However, the full $10,000 is still in my account. So if they charge me 4%, 5%, let's say, right, on a $2,000 loan, I'm still getting the 5% dividend on the full $10,000 still in there. So just so you understand how that works. That's a huge benefit here because potentially you could make the arbitrage. The arbitrage is the difference between the amount of the loan cost and what that money is still gaining inside your account. So for instance, if I'm getting a 7% dividend and I'm taking a 4% loan charge or interest charge on the loan, that amount that I'm getting a loan, I'm making a 3% arbitrage because I'm still making 7% as if that money was still sitting in my account. Okay, it is the most permanent form of life insurance. Most permanent form. So when you look at term, it can fail because you could outlive it. So if you have a 10-year term, you live 12 years, more likely than not, you're not going to keep that policy. Right? Same thing would be a 20-year, 30-year term, anything in between. If you outlive it, it's not really a permanent policy. That's why they call it term insurance. It's good for a term. A universal life contract, we explained in a previous video. The Wall Street Journal the very next morning released an article about people suing life insurance companies because they have universal life contracts and now they're all of a sudden they're asking them for huge amounts in premium, right? The Wall Street Journal came out with that the day before we had recorded a video on that same reason, on why it's happening. Not just the what, but the why behind why those policies are failing. So we know that universal life contracts can, if not properly funded, not be permanent. A GUL is the closest thing. A guaranteed universal life contract, which is what a GUL is pretty permanent in the fact that you pay it, it's there, there's just no cash value inside the policy. These policies, the whole life contract, if you pay your premium in full, on time, there is no reason that policy would ever lapse, okay? So, they're the most permanent form. They can be used to supplement cash needs in retirement. That is the proper way that you should use the cash in these policies if you're looking at it as a retirement vehicle. The reason for that is, like I said before, the money coming out, if you're taking it in the form of a loan, is not going to be taxable. So if you have 401ks, IRAs, all those different things through your employers, right, and you have that money, when you retire and you go to take that out, if you want a total of $20,000 a year coming from your IRA or 401k, you may have to take $30,000 to $35,000 out because you have to pay taxes on it to actually net $20,000. Here, if you want $20,000, you're going to take out $20,000 because it's not taxable, because it's the form of a loan, okay? So it can be used as a supplement. The death benefit rises with inflation. Now, when I say with inflation, it's not going to be determined by inflation. So for instance, it's not a cost of living or a CPI index kind of thing. What it's really saying is the death benefit is going to rise as you pay your premium over time. That should keep up with or better inflation, Okay, so very important, because some people buy a life insurance policy, let's say it's for $500,000. $500,000 today is a heck of a lot more than what $500,000 will be, let's say, in 20, 30, or 40 years. So it's something to keep in mind. So the net amount at risk, I wanted to show right now, I'm actually going to turn the camera. I want to make sure that everyone understands the inner workings of how a whole life contract works. So we're going to start here with the premium, the blue line. Okay, this blue line goes across. Now you'll see that it goes from blue to red. The reason I have that is because these are 10 pays, 20 pays, and paid up to 65, which means you only pay the premium for a certain period of time, and then you don't have to pay the premium anymore, but the cash value, the death benefit, that all continues to exist. The reason that people utilize these, and I'm more in favor of these than the paid for life, which is this red line, which means you're going to pay forever. The reason for that is because if individuals that are purchasing the policy come to me and say, Jim, I would like this policy to eventually supplement my cash needs in retirement. Well, if this is the case here, and you need $20,000 in this month, right? So you ask for $20,000. Well, if you still owe a premium that month, well, are you going to pay the premium and take the $20,000 out? It doesn't make any sense. So what you're going to end up doing is you are going to take a premium loan as well. So when you take that $20,000, if your premium is $2,000 for that month, you're actually, there's going to be a $22,000 loan going against your account versus only taking $20,000. So when you put this and you compound it, if you continue to do that, you're going to see that your policy is not going to perform very well because you're not paying your premium that's due on that account. If you have one of these policies, if you have a whole life contract that you have to pay for life, there may be a way to change the policy into one of these. Whether or not that makes sense for you, we would have to determine, or your financial advisor would have to determine whether that makes sense. Okay, so this is your premium, this blue and red line, depending on what type of policy you have. This green line is your cash value. Now what you're going to see is the cash value is going to go up over time. Okay, it's going to far exceed. Now when this point happens, when it goes past how much premium you've put into it, is going to depend on your age, your risk, your health, and all those different factors, what type of policy you have. This could change at different points. But let's say, for instance, for example, this is how it works. You're going to see here that the cash value is below the amount of premium that you've put into the policy at first, right? So this little bit here, you're putting in, let's say, $2,000 a month or $1,000 a month or $500 a month, but your cash value at the end of that year is less than what you put into it because there's a cost of insurance that you're paying for. However, you're going to eventually see that you have more cash value than the money that you've put into the policy. That's why I said over here, long-term cost should be or could be 0, or you could actually have more money in the cash value than you've ever put into the policy. So you're going to see this cash value going up, right? So dividends are being paid, interest rates, so that's what's happening with the cash value. Now you have this death benefit. And you'll see this death benefit, as we talked about earlier in the video, the death benefit rises over time. So this goes up over time. Well, if you, at this point right here, if you have $1 million in death benefit, and at this point right here, you have $400,000 in cash value, then the insurance company has a $600,000 net amount at risk. That means it's only costing them $600,000 to pay you $1 million, because most policies, you can structure it differently. Me, I don't really mess with those, but it's possible that you would still get the cash value and the death benefit. But for instance, the best performing policies, in my opinion, are the ones that you get this amount of death benefit and you don't get the cash value on top of it. So you'll get $1 million for you. You won't get 1.4, which means the net amount at risk, these red lines here, okay, is the amount the insurance company is losing by paying you the death benefit because you have that amount sitting in cash value. Okay, so if you don't understand it, you can always call us. We can sit down and we can break it down for you a little bit slower. But for time purposes, we're going to try and get through this as quickly as possible. So this amount, you'll see this net amount at risk, these red lines, they're going to get smaller because your cash value is going to increase with your death benefit, and eventually the insurance company is going to have almost no risk whatsoever to pay you that death benefit because all of it's sitting in cash value. This is so important to understand because that's why these policies can afford to perform so well. That the cash value can perform so well, the dividends can be paid, they're really a very good concrete product that allows you to build and accumulate wealth without risk in the stock market. This is why this happens, okay? So let's go back to this, right? The insurance company's risk goes down over time. So that's the net amount at risk that we just went over, okay? 10 pays, 20 pays, paid to 65, paid for life. Understanding which product you need, you have to explain to your advisor what the objectives are of purchasing this policy, and understanding how you plan to use it in the future is going to determine which product is going to be best for you. The one thing I didn't go over that I want to go over right now is waiver of premium. Waiver of premium is a rider that you can add to your premium that essentially says if you ever became disabled while this policy is in force and you were unable to work, that the insurance company would pay your premium on your behalf. That's not coming out of your cash value. That's not hurting your policy in any way, shape, or form. That is an additional rider, almost like a disability policy, that the insurance company is offering, that they will pay your premium for you on your behalf if you cannot work. That's a phenomenal feature to understand and to recognize, because at that point it is a self-completing contract. If I become disabled in year 8, well, how am I going to pay this premium? Oh, I'm sorry. How am I going to pay this premium? My cash value is then going to fall off. Am I going to have to, let the policy lapse? Am I going to have to cancel the policy? What am I going to have to do because I can't pay the premium anymore because I can't work? With the waiver of premium, the insurance company will pay your premium on your behalf so that the policy continues and you don't lose all that money and you don't lose that death benefit that your family needs so much. So we went over the benefits today. We went over the features and the inner workings of what's inside that policy and why it can perform so well, why people choose to use it. I'm not saying that whole life is best for everyone. And I'm not saying any policy is best for anyone. You have to understand what you're trying to accomplish and which product is going to meet your objectives for you. Not for the advisor, not for a friend, for you personally. What is it going to take in order for you to achieve your goals? So I hope this helps, and we'll see you next time. Take care, everyone.